Friends, a bank and a financial crisis does not happen because of one reason. But the primary, the overwhelming cause of the current financial crisis is fairly straightforward, very simple. The reason why it's normally not explained in straightforward and simple terms are three. First, there are many groups out there who are not really interested in the financial crisis as such, but they are more interested in exploiting the financial crisis as a mean to forward their political agendas. Then we have what I call the financial sector Monday morning quarterbacks, those who said nothing of nothing, and that have a vested interest into making it into a complicated debate. The more complicated it is, the more diluted their role gets, the more lengthier the debate becomes, and the more they can participate. And finally, we have the financial regulators, the experts, the tenured professors, the PhDs, all of those who just didn't understand or saw it coming, and who really must be embarrassed about it right now, or at least should be embarrassed when they are finally able to figure out what they did. Because it's simple and straightforward, I'm not going to use PowerPoints, calculators, or anything like it, but just a simple blackboard. And on this blackboard, I'm going to describe primarily bank operations. Banks can do two things, basically. They can invest or lend to what is perceived as not risky. And they can invest or lend to what is perceived as risky. Those are the two things. There is, of course, a continuum here, a lot of shades of gray, but at the end of the day, it is either perceived as not risky or perceived as risky. After the fact, obviously, these two groups get divided, split up in four quadrangles. Those perceived not risky, that were not risky, meaning those who lived up to the expectations, those perceived as risky, and that were risky, the clients didn't pay back, then we have those perceived as not risky, who were risky, bad surprises, and those who were perceived as risky but turned out to be they were not risky. Pleasant surprises. Perhaps many entrepreneurs and small business that came through and managed to use a bank loan to further the growth of the company. Now, looking at all this, these four quadrangles, from the perspective of what causes a bank crisis, what causes a financial crisis, we can immediately exclude two. We can, of course, exclude those who were perceived as not risky and were not risky. Obviously, they were not risky. They pay back, they have nothing to do with the crisis. Great. Out. And then, among those perceived as risky, we also find those who at the end were not risky. They repaid too, they have nothing to do with the crisis. And this leaves us with two quadrangles. The perceived as not risky that ended up being risky, the perceived as risky that were risky. Now, the regulators, they were scared about the perceived as risky. But in fact, the history of all the financial crises in the world shows clearly that the only place where crisis can originate is among operations that were ex ante or before, whatever you want to call it, perceived as not risky, because there is where the volumes of the operations grew so much so as to endanger the whole system. On the contrary, on those things as perceived as risky, which on top of it pay much higher interest that helps to pay for the cost of defaults and everything, those operations never grow into something that, current use of language, systemically important, nothing that really threatens the system. So clearly, in this area of operations perceived as risky, we didn't generate the crisis either. So we're back here at this quadrant. The danger, financial crisis, occurs always in areas that are perceived as not risky, but end up being risky. So now, what did the regulators do? Let me take back the conclusions first and go back to the starting point, the two operations that the bank can do. Well, the regulator said, for instance, if a bank gives a loan to a small business, an entrepreneur, someone perceived as risky, doesn't have a rating, then the bank needs to put up 8% in capital. If you divide 100 with 8, you get that the bank can leverage its capital 12.5 times to 1. But the regulator said, because they are perceived as being not risky and have AAA ratings, for those operations, the bank needs only to put up 1.6% in capital. And if you do the same operation, 100 now divided by 1.6, you end up that the banks can leverage their capital, in these cases, an amazing 64.5 times to 1. Let us suppose that a bank, for a very safe client, could obtain a margin of 0.5% for AAA client. If he had the same capital requirements for the other ones, meaning 12.5 to 1 the leverage, then that 0.5% times 12.5 would have given him a return, I'll put it on this side, of 6.25% on his capital a year. Nothing to write home about, and not really the stuff on which bonuses are made of, not really growth hormones for too big to fail banks. But that 0.5%, when it's allowed to be multiplied by 64.5, suddenly turns into 32.25%. And that is what big bonuses are paid out. And that is what helps banks to grow into being too big to fail. Now, these incentives, as you can see, these tremendous incentives for banks to invest in perceived as not risky, signified, and they were approved around June 2004 in the Basel II, signified that there was an immediate demand for AAA rated securities wherever. And the market, as market at last, the market always is, try to supply those AAA. And knowing, as we know, that AAA, real AAA is got to be something really scarce in this world, there weren't enough real AAAs, so the market produced, and they produced some really false AAAs. They produced these securities rated AAA backed with lousily awarded mortgages to the subprime sector. And trillions of dollars went after these AAA rated securities and over the precipice, and we fell into this crisis. So that is what happened. What do we do about it right now? Well, just a couple of words on that subject. 8%, 1.6%. By the way, this is a bit like a handicap officer on a racetrack that decides to take off the weights on the strong horses, on the horses believed to be good, and put the weights on those horses believed not to be good, or the weaker horses, but that we want to run, because the small business and entrepreneurs, we want them to run and get the credit. We want them to generate the next generation of jobs. If handicap officers, they do this and think that they still got a good race going, they're out of their minds. But this is what happened. So how do we do this? Obviously, we have to work out at eliminating the differences between these two. Because what the difference is, 8% there and 1.6 here, really means a regressive discrimination of the weaker. And that cannot just be, because in the market, the risk is already taken care of by the risk premiums. These have anyhow to pay the higher interest rates, and these anyhow get the benefits of the lower interest rate. And all this regulatory thing is just on top of it all, or better worded, underneath the table, because no one really knew what was going on with this discrimination. So we need to move up the 1.6, preferably to 8, and but we can't do that immediately, because if we take all this 1.6 to 8, the bank's not going to have any capital and going to stop all the lending. So meanwhile, on our route there, we probably have to reduce a bit also the percentage required capital for those perceived as risky. Perhaps take it down to 4% and getting this 1.6 up to 4%, and then moving both sides up. That's one thing we have to do. The other thing we have to do, obviously, is to change regulators. We cannot allow ourselves to be in the hands of a mutual admiration club over there in the Basel committee. No one knows how they're elected, and they're not accountable to anyone, totally untransparent. We have to get rid at least of 90%. We might leave 10% of the regulators there for historical purposes, historical memory, but we need to get fresh blood into there, people who really think. And the third and the most important part, before any further regulation, we need to define what is the purpose of our banks. There is not a word about the purpose of our banks in all the regulations we currently have. It is like a road regulator that's going to regulate the traffic, and who should be thinking about making it easier for traffic to go from point A to point B, suddenly only being concerned that nothing happens to the road. That is a little bit of the Basel Committee. They don't care what happens with the flows as long as the bank, nothing happens to the bank. And what does it really mean to us that nothing happens to a bank if a bank doesn't comply with what it is expected to do to society? So friends, in a nutshell, there you have it. This is the reasons why we got there and what we have to do. And I hope that you will take this little message and help me voice it there. I've tried as much as I can, but there is a lot of people who really don't want to sit down and take the time to go through it. And I tell them, please listen, it is easy, it is simple. Thank you very much.